Why you always lose money on prediction markets? Fast. Prediction markets are worse than you think. $100 billion betting scam exposed. Bet on everything. Markets have just had their best years ever. These platforms let you gamble. Trade on literally everything. From presidential elections to the number of starving children in active war zones, all the way down to whether Jake Paul gets the absolute snot beaten out of him in his next fight. Now, as a shock to absolutely nobody paying attention, the proliferation of these betting markets is already having some deeply questionable impacts on the state of our society. But that's incredibly easy to ignore when these platforms are bringing in this much money. Just Kalshi and Polymarket, the two largest prediction markets operating right now, are on track to handle over $100 billion in trading volume this year alone. That's not a typo. $100 billion. And other businesses have definitely noticed this gold rush. The mass adoption of betting on everything has become so widespread that it's actually threatening the thinly veiled gambling already facilitated by platforms like Robinhood and Coinbase. So naturally, they're just starting their own prediction markets as well to capture that revenue stream. Within just the last year, no less than 12 major organizations, including CME Group, Sports Illustrated, and Trump Media's Truth Social, have launched or co-hosted their own prediction markets. The goal is simple. No matter what platform you happen to be using for anything else, you can now conveniently bet your rent money on whether aliens will be officially confirmed before Grand Theft Auto 6 is finally released. Like a lot of modern financial developments, it would almost be funny if it wasn't going to have such devastating consequences on average people who can't afford to lose. But hopefully by now, if you've been paying any attention to technology and finance news, you already knew all of this basic information. What most people haven't noticed so far, though, is identifying the businesses and entities that stand to make the most money out of all of this prediction market explosion. And spoiler alert, it's absolutely not the market facilitators themselves. It's something much more insidious operating behind the scenes. Okay? So, as a bit of necessary technical housekeeping, it's important to understand the mechanical differences between modern prediction markets and more traditional bookmakers. A traditional bookie or sports gambling operator like DraftKings or FanDuel effectively makes bets directly against their clients in a straightforward transaction. If you bet on Ohio State to beat Michigan in college football, the company themselves needs to pay you real money if Ohio State does indeed win that game. Now, normally they are going to give you significantly worse odds than the true expected value of that bet, which is precisely how they make their profit margins. If the game is a true 50-50 toss-up with equal chances for both teams, then they might only pay out $1.95 for every dollar that you bet correctly, keeping that 5-cent difference as profit. The term bookmaker actually comes from a specific operational requirement. For them to operate consistently and sustainably without going bankrupt, they should build a balanced book of bets for both sides on any given game. This way, no matter which team actually wins, the losing bets pay for the winning bets, and the bookmaker gets to keep a nice little guaranteed margin either way, regardless of the outcome. Filling up a book of perfectly weighted bets is actually quite challenging in practice. If too many people bet on one particular team, then that leaves the bookmaker dangerously exposed to a potential massive loss if that heavily bet team actually wins. So to counteract this risk exposure, bookmakers will try to incentivize more people to bet on the opposing underdog side by offering them better odds and simultaneously making the odds worse on the team that already has lots of people betting on it. In the past, this would be done manually by human traders sitting at desks that looked exactly like regular stock trader desks in a hedge fund. But today, most platforms like this use sophisticated algorithms powered by machine learning to manage all of the thousands of individual games and events they take bets on simultaneously. Prediction markets like Kalshi, Polymarket, and the dozens of shameless copycats that are trying desperately to cash in on this degeneracy operate slightly differently from traditional bookmakers. They never directly take on the bets themselves as counterparties. They just offer a neutral marketplace where people can come together and trade on their disagreements about future events. You might log into one of these platforms and offer 20-to-1 odds on me reacting to this specific video in the future. But the platform itself doesn't take you up on that bet as the bookmaker would. It just posts your offer publicly until someone else comes along and agrees to bet against your position. The exact mechanics vary slightly between each one of these businesses, but they then normally take a small transaction fee of around 1% from whoever wins the bet as their revenue model. Now, this slightly different business model of just facilitating bets rather than directly taking them as a counterparty has allowed these companies to do a few strategically important things. The first major advantage is skirting around traditional gambling regulations. Since they are technically just facilitating trades between two separate parties who are voluntarily agreeing on a financial contract, they argue they should be regulated by the Commodity Futures Trading Commission, assuming they're regulated at all, rather than by state gaming boards. These bets are cleverly classified as just buying financial derivatives rather than traditional gambling. So the regulations and even age limits are not as strict as if they were overseen by a state gaming board with actual teeth. CoffeeZilla has done a series of excellent investigative videos on the absurdity of how these platforms get around laws that should obviously affect them. So I will leave a link to that content below if you haven't already seen his work, because I'm sure at this point, with the amount of gambling or gambling-adjacent advertisements you've had blasted directly into your prefrontal cortex, none of this regulatory evasion is all that surprising to you anymore. But the slightly less obvious thing that the business model of these bet-and-everything platforms has allowed them to do is to open up their back door to hedge funds, who can turn this whole ecosystem into their own protected hunting range. And it should probably go without saying, but you, the average retail user, are the prey being hunted in this scenario. One of the other less obvious benefits to the prediction market business model is that since these businesses don't take on any of the bets themselves as counterparties, the amount of capital they need to start these businesses is far lower than traditional gambling operations, even under the most accommodating state gaming boards. Regular casinos or bookmakers are legally required to have enough cash reserves to cover all outstanding bets and potential cash withdrawals at any given time. For big operations handling serious volume, this can easily be billions of dollars in required reserves, which represents a significant barrier to entry for any startup that wants to disrupt the gambling industry or prediction market space. The prediction market model means that people are betting against each other rather than the house, which means the business itself isn't directly liable for any payouts since they're just the middleman. Now, this has made it dramatically easier for every app in your phone to launch their own micro-casino or prediction market, but it does present another significant operational problem. For people to trade predictions, they need someone to trade against, and nobody is going to put up real money on a platform to trade against someone else if there's nobody there in the first place. Even the big established incumbents often struggle with liquidity across the thousands of potential markets they host every single day. So the solution to this liquidity problem is something called a market maker. In regular investment markets, a market maker will offer to both sell and buy a given security at slightly offset prices to make a little bit of money on the spread between those prices. They're essentially scalping small amounts of cash off regular investors on every transaction. But they are still seen as a welcome and necessary participant in the process. Why? Because it means if you ever want to buy or sell a stock, you will almost always have a buyer or a seller standing there ready to instantly transact with you. In the most basic terms, they are the people that stand around in the grand exchange all day flipping items for a small markup. In real financial markets, this market-making job is significantly more complicated because they're not only offering bids and offers for regular stocks, but also for a wide array of complex derivatives like options and futures contracts that can change value very quickly and unpredictably. Today, massive firms like Citadel Securities and Jane Street derive a large portion of their enormous revenue from market-making activities. The significant rise in what we can politely call undisciplined retail speculation has been one of their all-time biggest profit opportunities in history. Highly risky financial instruments like zero-to-expiry option contracts can generate huge returns for lucky traders, but they also present enormous risk and almost certain losses for most participants. Making markets for these kinds of financial derivatives has allowed the quantitative analysts and PhDs at these hedge funds to systematically extract value from people who are effectively just gambling with extra steps. The more reckless and uninformed their counterparty is, the easier it is for their sophisticated algorithms to create market conditions where if it's heads, the hedge fund wins, and if it's tails, the hedge fund also wins. Prediction markets take the reckless behavior of these retail traders and completely get rid of even the pretense that this is in any way something that could be considered legitimate investing. Unsurprisingly, major hedge funds have jumped enthusiastically into serving these markets. In their extensive and aggressive advertising campaigns, companies like Kalshi and Polymarket would absolutely love to make you think that you are betting against some other average Joe Sixpack who just happens to have a different opinion than you about future events. In reality, and in the best-case scenario, you're betting against someone who does this professionally with advanced algorithms. More often than not, you're actually trading against someone with inside information who knows something you don't. Now, at the moment, these platforms are actually so desperate to scale as quickly as possible that behind the scenes, they are offering direct financial incentives to hedge funds and trading firms who can provide them with liquidity in as many markets as possible. Other prediction market facilitators like Crypto.com have taken it one step further and set up internal market-making teams to trade directly against their own customers, which might make you think, hang on, doesn't that mean they have gone all the way back around and essentially become a traditional bookmaker again? The business's official answer to that legitimate question is basically don't worry about it, it's not great. But it gets significantly worse. Around 5 years ago, you may have remembered the major controversy surrounding the practice of payment for order flow. A firm like a big hedge fund would pay a broker like Robinhood a substantial fee, and in return they would get to be first in line to facilitate any customer trades if and when they were made. The same kind of direct process doesn't translate perfectly to prediction markets, but the preferential treatment absolutely can and does exist. All of these prediction exchanges have sophisticated back-end trading interfaces with a range of powerful features that are not available whatsoever to regular retail users. These include broad market data access, low-latency connectivity for faster trading, bulk order management capabilities, drop copy functionality, and IP whitelisting for priority access. Naturally, these advanced programs are only available to institutional partners and major hedge funds, although you are technically welcome to ask for access to them if you want to be laughed at. In regular investment market exchanges, like the Nasdaq and the New York Stock Exchange, regulators and exchange operators have actually tried really hard to curb the unfair advantages that big hedge funds can gain through tricks like high-frequency trading and dark pool markets. They have done this because if a market becomes too obviously unfair, then regular retail investors are eventually not going to participate in it anymore. These prediction exchanges have gone the complete opposite direction, though, and have basically created a perfect playground for sophisticated market makers to systematically profit off regular traders who don't understand what they're up against. Now, you might be thinking, who really cares about this? Most people opening up Kalshi or Polymarket are happy to acknowledge what the regulators won't. This is just gambling with a fancy technology wrapper. Nobody goes into it actually expecting to make money long term, right? Well, this should be true, but the underhanded way that money is being systematically extracted out of these markets, separate from the platform fees themselves, is going to make them even harder to regulate effectively and even more lucrative for companies to push on to as many vulnerable customers as possible. The real problem isn't that people are gambling. People have always gambled. The problem is that we've created a system where sophisticated financial institutions with algorithms and inside information are systematically taking money from regular people who think they're just making fun bets with their friends. It's not a fair fight. It's not even close to a fair fight. And the platforms know this. They're actively facilitating it because the more trading volume they generate, regardless of who wins or loses, the more transaction fees they collect. This is the dirty secret of prediction markets that nobody in the industry wants you to understand. You're not betting against other regular people with different opinions. You're feeding money directly into sophisticated algorithms designed by some of the smartest quantitative analysts in the world whose entire job is to extract value from you. The house always wins isn't just a cliche, it's the fundamental business model. And now, the house has gotten much more sophisticated and much better at hiding what they're doing. I hope in whatever way it can, this video helps to expose the way that this industry is really cashing in on desperate people who can least afford to lose. The next time you see an advertisement for one of these platforms promising easy money or claiming you can profit from your opinions, remember that there's a reason they can afford to spend hundreds of millions on advertising. They're making it back many times over from users who don't understand the game they're playing. Have you used prediction markets? Did you know hedge funds were on the other side of your bets? Share your experiences in the comments. Subscribe for more investigations into how money really works. And let's shine a light on these predatory practices together.